Ladies and gentlemen, welcome back to the channel. Equities got rocked today for good reason, and I can officially say we are now on crash alert for our markets. What this means is things have now shifted. They've shifted psychologically. They've shifted on a technical basis, and we'll talk about that shift and what could inevitably come from our markets. We do have some data throughout the rest of this week that we will talk about, but I think the big story could be Nvidia earnings coming not this week, but next week. Throughout all of this noise, if you will, we'll discuss what I expect to happen next for Tesla stock, whether I am buying, holding, or selling my position in Tesla. And if you are viewers of this channel, you should already know that answer. But first, take a look at one of the nastiest, and I mean nastiest rug pulls that I have ever seen in equities. Lift in after hours up 65%, got brutally destroyed.
And now the mark. Oh! Oh! It went to zero! Yo! And bam! There we go. Squid Games. Sayonara, motherfucker.
Yeah, I had to put the squid coin reaction to the rug pull in here because I think it fits pretty well to Lyft also. Let's go ahead and get started. We have some work to do. Morgan Stanley's Adam Jonas actually came out with a very interesting note in regards to Tesla. He says EV sentiment is extremely negative and will eventually deteriorate further. In our view, our clients want our auto companies to do a combination of four things: spend less, spend slower, spend smarter, and return cash. Now, what does return cash mean? That means either issue a dividend, which in the case of Tesla is probably unlikely, but buybacks. That's also a way of rewarding shareholders. What buybacks also do is, again, lower the amount of shares outstanding, and that can make your EPS grow a lot faster, which rewards shareholders and ultimately sends stocks higher. So for those of you guys that do not want to see Tesla do a share buyback, you're basically saying I don't want Tesla's stock to go higher. So really only the bears would be saying don't do a share buyback right now. And let's be honest, Tesla in the 180s is exactly when you would want to do a buyback. Not to mention, if the stock does fall further from here, we'll discuss the odds of that actually happening later in this video, but you should be team buyback for Tesla. And a matter of fact, just my opinion, if Tesla had announced a buyback last earnings, the stock probably would have been up 5 to 10%. Instead, it was down 10%. Just based on a buyback alone, you would have seen the stock react very positively. First up, I want to put this into context for everyone out there. A shift, yes, did occur today. The fear was unlike anything you have seen in over a year. You thought October, November was anything? No. The VIX at one point today was up about 29%. Even at the close of the day today, given the markets did rally a little bit towards the end of the day, the VIX was still up about 14%. Now, the VIX measures puts to calls on the S&P 500. So when the VIX spikes like that, it was showing a ton of puts that were being bought. The Russell 2000 closed down almost 4%. The NASDAQ down 1.8, S&P down 1.4, and the Dow down about 1.35. Considering all of this carnage, Tesla stock only down 2.18%? I'll take that any day. That's actually showing quite a relative outperformance on Tesla's part. I mean, Tesla and Microsoft were both down about the same today, which, given how much fear and pessimism is surrounding Tesla stock, that's phenomenal. So I think this shows us that even if we do get some big downside in our markets, you've already seen Tesla get re-rated and repriced. And really what that means is Tesla has already been trading as if we're not getting that many rate cuts. Tesla's business is not going to accelerate due to rate cuts. If Tesla's business slows down, well, it's probably already priced for that. So fundamentally speaking, it's easier to swallow this bad news that we got today in Tesla compared to, well, the broad markets. Now, part of this change that I'm referencing today is the sharp uptick in inflation. Now, this was not just in one sector or spot of the inflation report. Your super core really accelerated. Liz Ann Saunders on X says the jump in January CPI is not just a housing issue. CPI core services, excluding housing, increased by 0.85% month on month, month over month. That's insane, okay? That's the largest increase since April of 2022. And Zero Hedge shares this chart of CPI Supercore month over month. And ever since really the start of 2023, although you have seen progress here and there, Supercore is definitely uptrending. You're now to the highest point you have been in Supercore inflation since about 2022, about midway through the year. And it's really even broad-based. I mean, the other here is 0.22%. That's a decent amount. Transportation services came in at 0.23. Medical care services came in at 0.17. And a lot of this could be due to all of the wage increases that companies have had to pay. That cost is not going to all be absorbed by the companies. And it takes a while for the companies to figure out, like, hey, what are we going to raise prices on? How are we going to do this? Usually there's increments and steps to this. So this looks like a reacceleration of inflation, at least the beginning of one. That's why the VIX actually spiked 29% at the highest point today in the most aggressive daily move in the VIX that you have seen in well over a year. I believe a 29% rally in the VIX has not happened since the Rona crash. Now, obviously, it's going to be very volatile, but I do think this puts a lid on how higher markets go here in the near term. After all, I believe I'm the first one to say this, and I don't think you've heard this from anyone else, but I think there's a decent chance we may not get a rate cut in all of 2024. Look, if the economy does not start to do poorly, which it doesn't look like it's going to, that's not the trajectory that we are on. It looks like, if anything, the economy's accelerating. That can tend to lead to more inflationary pressures in and of itself. Maybe a topic for another video. But if that doesn't happen, if the economy doesn't take a sharp down move, and inflation continues to rise or even stay around where we are now, you're not getting a rate cut. So if you're betting on rate cuts in 2024, I don't know. I'm the data that I'm looking at, that is public data, does not support the Fed cutting rates right now. Typically, the only time the Fed cuts rates during a hiking cycle or at the end of a hiking cycle is when the economy starts to turn down. If there is no economic downturn, then that will solidify. The neutral rate is higher, and the Fed will, again, have to stay higher for longer. Now, I do want to be very honest with you. My base case is not for 0 rate cuts. I think 1, maybe 2 rate cuts. I'm more leaning towards about 1 rate cut this year, towards the end of the year, probably right before the election. I would say in September, maybe even around November 7th. We could get 1 rate cut, but that's all it's looking like right now. Now, this is a problem because even your big tech names to some degree have been trading based on a soft landing, based on, 7 to 4 rate cuts. We used to price in 7 rate cuts in 2024 at the beginning of 2024. Now we're pricing in 4 after today. Well, as we start to unprice those, as maybe we drop down to 3 or even start to drop down to 2, that likely even puts pressure on your big tech names because they are trading at very high valuations. Just inflation alone brings down the value of company earnings, because if you're expecting, let's say, 2% inflation for 10 years, well, theoretically, a company that's promising all this revenue 10 years down the line, you almost have to discount that by about 20%, right? Because that's your rate of inflation. If you add into the mix, you can get almost 4.5% on a 10-year treasury for, let's say, 10 years. You really have to start discounting those future earnings from companies. So even highly profitable names that are growing, like a Microsoft or an Nvidia or Google or Apple or some of these stocks that have held the markets together, you have to discount their earnings as well. And then the multiples just really don't look attractive. I mean, they already don't look attractive to anyone that is remotely investing in stocks for any kind of value. You're paying a hefty price today, and that is if all goes well. I'm saying this was the start of a new change in investors' psychology. It appears as if we may not give inflation the benefit of the doubt that it's going to continue to fall. This is going to make the markets a lot more data dependent, and I do think it probably stops the parabolic rise that we have seen lately. And I do want to be very clear, markets are not going to go straight down. This is the start of what could be a downturn. Typically, these downturns, these correction-like events can take weeks, if not, 1 to 3 months. So by no means am I saying stocks are going to continue to fall 2% every day, but the trend is probably going to be lower here. If Goldman Sachs is correct, then maybe we could get back to kind of this market that we have been in, but it's still going to take some time. Goldman says CPI largely reflected start of year price increases for labor reliant categories such as medical services, car insurance, repair, and daycare. And we assume inflation in these categories returns to a previous trend on net in February and in March. I wouldn't necessarily say that we're going to go straight back to trend in February or March because there's likely tiers to companies raising prices. It's usually not one big price, increase at the start of the year. So I would argue with this a little bit, but I mean, even if it takes a while, it's not going back to 9%. CPI is not going back to where it was in 2022, not even remotely close, but this will vastly, in my opinion, delay the amount of rate cuts we get and when we start to see them. Ryan Dietrich says many doom and gloom bears have turned into bulls. There is deterioration under the surface, and take note that right now for the next 6 weeks historically isn't great for stocks in the 4th year of a new president. Oh, and the S&P 500 is up 14 of 15 weeks. Seasonal weakness is normal, and that's actually the only point that you tend to actually go negative during the fourth year of a new president is, really from March. You tend to see a pretty consistent downturn throughout the month of March. So again, if we do see some weakness here, it's not all too unprecedented. T.S. Lombard says, quote, "There is no return to 2% inflation without a recession of some sort. The January CPI data, and more critically, the acceleration of service inflation since the economy skirted recession last spring, tells us just that." Now, with all of this being said, we do have some data throughout the rest of this week. Tomorrow, we have final PPI month-over-month numbers for December, so we're going to get a revision here. We're expecting negative 0.1%. If that comes in positive, well, that would be negative. You want to see it come in as negative as possible. On Thursday, you are going to get retail sales that will affect the GDP estimates because about 73% of the economy is really evolving around people spending money. So if retail sales come in negative or bad, that's going to be bad news. We're actually expecting negative 0.1% month over month, but you're coming off of December. So that would still be a pretty strong number if you're only negative 0.1% month over month, when December was positive 0.6%. So that would actually be a real gain of like 0.5%, right? So that would actually be pretty good. Philly Fed CapEx, Philly Fed manufacturing, New York Empire State manufacturing, export prices, import prices, initial jobless claims, industrial production, capacity utilization, manufacturing production, business inventories. All kinds of data will be coming out on Thursday. That will be very important. And then on Friday, building permits, preliminary numbers for January, and PPI month over month will be coming out. You're actually expecting for the month of January a positive PPI of 0.1% on a 12-month annualized basis. That's 1.2%. That's not a problem at all. That is exactly where you want PPI to be. Producer price index. This is like producer price inflation, right? What companies are feeling for their cost. And if they're seeing more cost, if PPI is higher, they're probably going to cost or pass on those costs to consumers. That leads into CPI, which is Consumer Price Index. 10 o'clock in the morning on Friday, we'll get Michigan Consumer Sentiment Survey as well. I think this data will be important, but at this point, if you see a little bit of weakness in some of these data reports like retail sales, PPI, signs the economy is maybe not as strong as we think, that could go back to being a positive for stocks. Just given the huge rise we just seen in inflation. Now, I think by far the biggest catalyst for the broader markets is probably going to be Nvidia earnings. Now, Nvidia earnings will come out next Wednesday on February 21st. Nvidia has sold off the next, 2 to 4 weeks after Nvidia's earnings. The last 3 earnings, and Nvidia really was just trading in a range for the last 9 months or so before this latest breakout. Now, back here, you ended up dropping about 10%. Back here, you ended up dropping about 10%. And the last earnings, Nvidia ended up falling about 10% as well. I actually believe 2 earnings ago, you've ended up falling like 18%. I believe I'm a little wrong there. 22% if you're counting the after earnings high that you've seen to the low you've seen about 2 months later, you ended up falling like 22%. Now, I do think a lot of capital, especially from Tesla, $200+ billion of value Tesla stock is lost. I think a lot of that money has ended up in Nvidia, and if Nvidia's last 3 earnings have showed a trend, it is this: Nvidia typically rallies into earnings and then sells off after earnings. No matter how good it is, I don't think Nvidia goes higher after earnings, no matter how good it is. I mean, you would truly have to deliver something that is jaw-dropping if you are Nvidia to see another 10-20% rise after earnings. I think a lot of people are betting on that, and I think a lot of people are going to lose a lot of money taking that trade. But with that being said, Nvidia falling could help broaden out our markets. That could be a positive for, I guess, your interest rate sensitive names, the stocks and areas that sold off today, like the Russell, like Tesla. They could actually benefit from some of the AI getting priced out of our markets. The headline SPY and triple Qs, well, may not like that. Then there's always the unlikely outcome that Nvidia reports something negative and, well, the stock sells off big, but that seems very unlikely. Option activity was a little bit higher today from hedge funds and institutions in Tesla stock. You had 716 orders totaling $730 million with a positive order value of 53%, so pretty neutral overall. Now, as far as the S&P 500, you did gap down today. There is a gap due to CPI. Now, odds are the SPY, the S&P 500, probably falls about 7-ish% over the next month or two. Now, could you fall more than that? You could probably fall about 10% on the low side. That would put the SPY back to about 453 or so. I wouldn't see it getting any worse than that, but I mean, after all, it's possible. I think a pretty reasonable assumption is about a 6% reset in the SPY. That would take you back to where you were only in December of 2023. So could it get a lot worse than that? Obviously, I think it'll come down to how good or potentially bad Nvidia earnings are. If you do fall more than 5%, I have to imagine Nvidia has bad earnings, which I'm going to say is probably unlikely. So 5 to 10% downside from here seems likely in my personal opinion. You're now under 500 on the SPY. That is also psychologically important. Now, Tesla stock, with that being said, if we have a slow kind of decline, I don't think Tesla really has to decline because you've already fallen so much in 2024. Like if we have just for an example, 1% up day, down 1.1%, 0.3% up day, down 0.4%, up 0.1, down 0.2, kind of like that, and we just kind of trickle downwards, then I don't think Tesla stock needs to, dramatically come down from here. I think it's already priced again for bad news, and I think that's why you've seen to some degree a relative strength come out of Tesla stock today. Now, if Tesla does fall and the markets fall pretty aggressive over the next, 1 to 2 months or so, 4 to 8 weeks from here, Tesla stock's probably going back to about 170. If things get really bad and Nvidia, let's say, misses earnings, then Tesla stock could fall to about 150. But that is all the downside that I even think is possible here in Tesla. Unless Tesla were to cut prices or give us some kind of really bad news, then of course anything is truly possible. But I don't see much further down than 150. I don't even think 150 is likely. I think 170 is probably like a 50% odds. And that's not even a far drop from here, guys. After all, Tesla's the worst performer in the S&P 500 to start 2024, so it's already declined a lot. That's only about 7.5% down from here. That's like nothing in Tesla standards. Now, for any upside in Tesla stock, and if the markets can kind of brush off the CPI that we've seen today, maybe the labor market weakens a little bit from here, maybe the economy weakens a little bit from here, maybe it's justified that the Fed does actually raise rates 3 to 4 times in 2024. I'm still targeting that 210 level in the near term. But again, I do think there's going to be a lot of volatility. And let's be honest, if Tesla were to announce a buyback, which probably wouldn't happen at least at the bare minimum until next earnings, which will be early in March or so, well, that could be a big catalyst to send Tesla stock higher. And I really don't think that is something Tesla stock is priced for. So I do think there's a lot greater of a potential for an upside surprise here, even in the short term from Tesla, than a downside surprise. But you could still fall. I mean, if I'm sitting here and saying the markets fall 5 to 10%, the speed in which is important, I would expect some downside, especially if you're pushing, 10%. You're definitely not going to be at these same prices if the S&P falls 10% from here. 5% on a slow decline? Well, you could make the argument that Tesla's already priced for that. That the S&P and the Nasdaq probably should be down 5% from here, just based on CPI that we got. Markets going from 7 rate cuts to 4 rate cuts. Should stocks have been at all-time highs? Probably not. Tesla stock is hell of a ways away from all-time highs. It's likely already priced in all of this bad news. Last but certainly not least, what am I doing with my Tesla position? Am I buying? Am I holding? Am I selling? Well, indeed, I'm buying. Okay. I figure most of you guys already knew that. Anything under $200, I'm aggressively buying. The way I look at it is more so a simplistic point of view. Everyone's so negative on Tesla right now. The multiple has went from about 65 down to about 43 for next year's earnings for Tesla. Now, let's not get too complicated here. Last year's EPS for 2023 was $3.67. I believe Tesla can easily come in around $4.20 of EPS for 2024 EPS. Well, if we assign a 60 times multiple on that, that is 252 by the end of this year. That's a really low base case assumption in my personal opinion. Now, what could it be if we get multiple expansion? We actually do see rate cuts and the demand picture picks up and Tesla focuses on becoming more profitable. I think that is something that is widely underlooked right now. If Tesla just tries to become more profitable. Tesla has not tried to become more profitable. Companies that have done very, very well. And I think Tesla's multiple would expand if we had higher expectations of larger EPS over the coming years. That could bring Tesla's multiple to 100. That's pretty low historically for Tesla anyways. That could put the stock at about 420 by the end of this year. So that's in a really good kind of outcome for 2024. Even on the worst case, in my opinion, it's still dramatically higher from here. And if I knew that Tesla's going to be even 250 by the end of 2024, I would be buying stock in the 180s. So that's what I'm doing. I don't have a crystal ball. This just makes a lot of sense to me. Let me know what you are doing down below in the comment section. Is it going to be volatile? Sure. Is it going to be up and down, back and forth, spin your head? Crazy. Yes, it is. But I think Tesla stock is, quite frankly, undervalued at these prices. Let's be honest. With that being said, hit the like button as well as subscribe to the channel. Thank you for watching. Enjoy the rest of your day. Check out the trading community if you guys want to come trade with us live in real time. Link down below in the description of this video as well. Go ahead and follow the X account. It's Michael Tyler over there. We talk about a lot of what we get into here in these videos on X first. So join the party over there. Thank you for watching again. Enjoy the rest of your day, and I will see you in the next one.